Hello traders, welcome back to the Forex Geek, where we dive deep into the tool that can help you make smarter trading decisions. And in today's video, we are going to be talking about the absolute strength indicator, a valuable tool for identifying market trends and momentum. So stay tuned as we break down what it is, how it works, and how you can use it effectively in your trading. We start by understanding what the absolute strength indicator is, and the absolute strength indicator is designed to measure the strength of buyers and sellers in the market by analyzing data from the RSI, which is the relative strength index, and the stochastic oscillator. It plots this indicator, the absolute strength indicator plots two solid lines, the green line, in this case the blue line, and the red line for sellers. This is basically what it is talking about. Let's change this back to the green line so that we would not complicate ourselves. Now, the green lines are for buyers and the red line are for sellers, along with two dashing lines. Two dashing lines when the green line cross above the red line. When the green line cross above the red line, it signals a bullish trend. But when the red line crosses above the green line, it signals a bearish trend. This is basically what it's about. The distance between the lines reflects the trend intensity, with wide gaps showing stronger trends and narrowing gaps, narrowing line. When you see a narrow line, it signifies weak momentum. So when the strength in the market is strong, the indicator shows a wider line, but when it narrows down, it shows weak momentum in the market. This is basically what it's about. So let's look at how to trade using the absolute strength indicator. The absolute strength indicator. Let's see how we can trade using it. The first step is to trade. The first step of trading the absolute strength indicator involves a systematic approach to identify and capitalizing on the market trend. The key is to focus on the relationship between the green and the red line, which represents buyers and sellers' strength respectively. You begin by looking for crossovers. When you see a crossover, when the green line crosses above the red line from this indicator, as we can see in this area, when the green line crosses above the red line, this indicates that buyers are in the market, a potential bullish trend. This is a cue to consider entering long position. Conversely, when we notice the red line crosses above the green line, this indicates sellers are in the market and a possible bearish trend is coming. We only have to look for selling opportunities when we spot the red line cross over the green line. Now let's get a perfect example of where the red line crosses above the green line. From this area, we can see we are trending to the downside. Let's look for a more solid example to better understand what we are looking at when the red line crosses over the green line. And as we can see in this area, the red line is above the green line, signifying that we're in a downtrend. As you can see, price is breaking structures to the downside, signifying a downtrend. Now, once you have identified the trend, you confirm its strength by observing the gap. You observe the gap between these two lines on the indicator. When you notice a wider gap, it indicates a strong trend. But when you notice a smaller gap indicates a weaker trend, possibly a consolidation. This information helps you to gauge the potential longevity of your trades. For entry timing, pay attention to the dash signal line. For entry timing, for the dash signal line. when the solid green line crosses over this line in the center, when the green line crosses over the red line, this indicates your buying position. You have to look for your bullish position. You look for an opportunity to enter up to the upside. As we can see in this area, when the green line crossed over this red line, price went to the upside. Similarly, when you have to watch out for when the red line crosses above the green line, this indicates we are in a bearish trend. When we can see a crossover in this area, this indicates that the market will potentially move to the downside. After entering the trade, let's assume we enter the trade. After we see this crossover, we enter our position. After entering the trade, you use the indicator for ongoing management. You manage your trade. If you enter the position, you set your stop loss above the previous high in terms of a selling position. Then you use this indicator to monitor your take profit. When you notice the indicator is running and wants to cross over back to the bullish side, this is where you would exit your position. This is how to trade using this indicator to manage both your longs and short position. Now, if you are in a long position, let's enter a long position. Once we see the crossover and we see our bullish confirmation, when we see the crossover, you can also wait for a retest of that area. You can also add your support and resistance area on the chart to further help you to add price action to this indicator. Once you notice price as the indicator, the green line has crossed above the red line, and price comes back to rest on your support region or your previous resistance region, you can enter your trade in that area. You put your stop loss just below the previous swing low. Then you use your indicator to manage your trade. The moment you notice a cross back over, or moment you notice that price, the gap between the green and red line is reducing, this can be an opportunity for you to leave the trade. So basically, you are using this indicator to manage your trade and to get a good timing for your entries. This is how to use this indicator to your advantage. Remember, risk management is crucial. You must always place your stop loss below a swing low in a long trade, and in a short position, you place it above a swing high. This approach would always help you to protect your capital while giving the trade room to breathe. Never risk more than 1 or 2% of your trading capital on any single trade. This should be your risk threshold per a trade. Just risk at least 1% or 2% of your trading capital on a single trade. Alright traders, we have come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. If you found this video helpful, do not forget to like, subscribe, and turn on your notification bell so that you will never miss out on more trading tips and strategies. Thank you for watching, and I will see you in the next video.